All right, welcome back, everybody. Docket 250104. Just want to happy Father's Day to everybody who celebrated yesterday. And just want to start with asking the company for any administrative matters.
Good morning, Commissioner Arconti. Two minor administrative matters, just related to the panel. We do have one addition to the witness panel, which is Miss Andrea Van Luling, who is here and has previously been sworn in. And then just noting that Mr. Daniels and Ms. TheBurge have not been sworn in. With the exception of them, everyone else has been, and that's all we have as administrative.
Okay, thanks. I can administer the oath then to the folks who need to be sworn in. So please raise your right hand. Repeat after me. Do you swear to tell the truth, the whole truth, and nothing but the truth under pains and penalties of perjury?
I do.
Thank you very much. Attorney Vaughn, would you like to adopt the
Absolutely.
file?
And
Sure.
sorry, I apologize, Commissioner Arconti. Mr. Patel is indicating that he too should be sworn in. So if hate to do that again, but if
Yeah, just to cover our bases, could you raise your right hand, please? Do you swear to tell the truth, the whole truth, nothing but the truth under pains and penalty of perjury? Thank you. Okay.
Thank you. To the panel, would each of you please state your full names and positions for the record, please?
Devang Patel, General Manager, UIL Holdings.
Nicholas Daniels, Director of Billing and Revenue Recovery on behalf of UI.
April TheBurge, Vice President Accounting on behalf of UI.
Katarina Miller, Principal Analyst, Wholesale Power Contracts.
Christy Prescott, Vice President of Regulatory for UIL.
Heather Tabbitz, Director of Regulatory for UIL.
Kathleen Wasselnick, Supervisor Credit and Collections for UI.
Lisa Rosso, Senior Project Manager for UIL.
And Mike Crowley, Manager Clean Energy Policy, UI.
And to the panel, as part of your preparation for this late filed exhibits hearing, did each of you sponsor or co-sponsor responses to late filed exhibit requests and supplemental responses to interrogatories issued during the course of the evidentiary hearings in this case?
Yes.
Yeah.
Yes.
Do you have any updates, corrections, or clarifications to any of your late filed exhibit responses or supplemental interrogatory responses not previously identified for the record?
No. Yes.
Thank you, Mr. Patel. Can you please explain that correction?
Yes, on late file 4 in the table, item 2, it should have been labeled Bridgeport Solar instead of Bridgeport Fuel Cell.
Thank you. And subject to that correction to the panel, do you adopt your late file exhibit responses or supplemental interrogatory responses as part of your sworn testimony in this proceeding?
Yes.
Yes.
And lastly, to Ms. Miller, for the purposes of admission into the record, have you reviewed and do you adopt the supplemental interrogatory responses sponsored by Mr. John Stanley?
Yes.
Thank you. The panel is available for cross-examination.
Thank you, Attorney Vaughn. We'll turn it over first to authority staff. Mr. Arpin.
Thank you, Commissioner Arconti. So good morning. My name is Christopher Arpin, and I have some questions regarding late file exhibit 1. And so just for some context, I understand that UI is only seeking to capitalize the 2-tier LiDAR implementation cost. So in relation to these questions, I would like to gain a better understanding of UI's accounting practices, internal controls, and potential rate impacts, specifically if internal labor costs were capitalized across multiple RAM-related projects. So some of these questions might be more hypotheticals, just to start off with that. So my first question, so UI is seeking to capitalize its LiDAR Tier 2 implementation costs, which include approximately $600,000 in internal labor expenses. Late file exhibit 1 includes a copy of UI's capitalization policy, which permits the capitalization of labor costs for employees who are directly involved in internal use software projects such as LiDAR. Could UI please confirm whether or not the internal labor costs associated with the LiDAR Tier 2 implementation are already being recovered through accounts included in base distribution rates?
I think, and my colleagues can help me if I misspeak, but I think that's under discussion at the moment in the current distribution rate case. And so that's one of the issues we want to consider is what is the right place for those implementation costs? Because to your point, they should be in one spot or the other.
So I guess my question is, so the internal labor associated with the LiDAR Tier 2 implementation, presumably those internal labor costs were already potentially included in the base distribution rates if the employees were already hired. So my question is, are those costs for the LiDAR Tier 2 implementation included in the base distribution? Could the company please confirm?
Well, they would be in the proposed plant additions.
Okay.
For the base distribution. It was something we spoke about, I think, in the rate case hearings. So yes, those employees' base cost is part of your revenue requirement until you capitalize a piece of those costs, and then you have a credit to the revenue requirement for the amount that is capitalized. So this we're speaking about is the plant addition. And so where does that plant addition belong in the rate making?
Okay, thank you. So my next question, how does UI ensure that internal labor costs are not being double recovered, i.e. recovered through base distribution rates and through the RAM if the LiDAR Tier 2 implementation costs were recovered through the RAM? Please describe all of the company's internal controls or accounting procedures in place to prevent such duplication.
One moment, if you don't mind. So this is Andrew. Just to backtrack on your previous question. So the revenue requirement for the distribution rate case would include all payroll with a credit for any expected capitalization. So we look at the capitalization rates from the history of what's happened, and we back that out of the revenue requirement. So there is no revenue requirement for the capitalized portion of expected plant additions. Then in 220808, future capital additions, including labor, were not included within the base rate revenue requirement. So from a capital labor perspective, the only thing that's in the revenue requirement is capital labor that had been included within plant additions, which had been completed before the close of the evidentiary record in 220808. And I need you to repeat your last question. I missed it. I'm sorry.
Okay, yeah, thank you for that response. That makes sense to me. So just going back to my question. So how does UI ensure that internal labor costs are not double recovered, i.e. recovered through both base distribution and through the RAM? Could you please describe your internal controls or accounting procedures in place to prevent such duplication?
So you're asking specifically for capital labor?
Yep.
Okay, so capitalized labor, each employee is responsible for charging their time and their manager is responsible for reviewing their time. Capitalized labor has to be assigned to a certain work order, and it can only be assigned to one work order. So I can't double bill by time. I have to assign each hour that I put in the system to a work order. So if I'm working on something that's capital related, I charge that WBS for that capital project. Then it's reviewed by my manager, who should know what I'm working on a daily basis. So they review the time charging and they ensure that by looking at the WBSs that the time charging had been correct. So the time charging is, the control itself is the employee inputting the time and then the manager who reviews that time charging and going to those WBSs. And then the system is set up so that it bills it, and we have ITGC controls over how it shows up in those different WBS orders.
Okay, thank you for that response. So another question on this. Slightly different FTE related topic. So would the same methodology and accounting treatment also apply to the internal labor costs associated with clean energy and grid modernization FTEs recovered through the NBFMCC mechanism?
So what I just said the controls follow, regardless if it's capital or if it's an operating, expense line item on the income statement. So if I'm doing operating expense work, the WBS, where I'm charging my time to, that WBS is set up to allocate to either capital or O&M, or to those specific programs that you referenced.
Okay, thank you for that response. One moment, please. Thank you for your patience. Now moving on to a slightly different topic, keeping on the capitalization of project costs. So is it true that when the company capitalizes certain project costs, those costs are typically recovered through annual depreciation charges applied over the useful life of that asset?
That's true. However, again, like I mentioned, in 220808, the only depreciation and the only future capital that was included within that revenue requirement was the items that we had capitalized as of the close of the evidentiary record. So everything that we've done from a construction work in progress to closes in plant subsequent to the close of the evidentiary record in 220808 is not currently being recovered.
Okay, thank you. So in regards to the potential recovery of capitalized projects within the RAM, such as the two-tier LiDAR implementation costs, would the company follow the same methodology of only charging customers, say, a depreciated portion of those assets year over year, or is there a different mechanism that the company would use for that specific cost item?
So plant recovery is usually two aspects: return on and return of. And so depreciation is the return of, because it's your whatever you spent on the asset divided by the useful life spread over that period of time. But then there's the recovery on, that's when the plant ends up in rate base. And that's the portion that ends up in the revenue requirement, where it's the allowed return times the equity ratio times your rate base portion. So to recover plant balances consistent with how you would recover them in a distribution rate case, you would get both of those aspects.
Okay, thank you for that response. Those are all my questions. So I'd like to thank the panel for their time today.
Thank you. Jim Riley with Authority Staff. Just really, you utilize the acronym WBS. Just for the clarity of the record, what does that stand for?
Work breakdown structure. It's basically a grouping of work orders that delineates a project or program of work, a scope.
Okay, thank you. Understood. That's all I have. Thank you, Commissioner.
That concludes Attorney Norton.
Just a couple follow-ups on that line of questioning. I'm Jonathan Norton with Authority Staff. On the topic of the capitalization of the Tier 2 LiDAR, isn't the portion of the internal labor at the time of the previous rate case hit, it would be fixed for whatever personnel were to be working on, any capitalized project. Is that correct?
Are you asking about the revenue requirement, or are you asking about what would be fixed, I guess is my question.
Yes, the revenue requirement. So what would be included in base distribution rates for recovery?
So if We earned if we earned a recovery of future plant and service, in theory, it would be fixed, right? Because it would be the expected salaries at that time times the number of employees you have, backing out that capitalization rate. But when we go back to 220808, again, the revenue requirement that we're collecting on is the total salaries less what's expected to be capitalized. We're earning a recovery on anything that had been capitalized and put into service through the close of the evidentiary record, but we're not earning recovery of or recovery on any plant subsequent to the close of the evidentiary record. So anything that was incurred after that, it is not fixed, it's not included in rates.
Right. Thank you. And so since that's true, when the company presented the tier 2 LiDAR internal labor for recovery in RAM, was the exact portion that would have been credited for the capitalization presented for recovery in RAM, or was it the actual costs incurred by the company for recovery in RAM?
The actual cost incurred.
Okay.
Again, when you're talking about capitalized labor, it's not like O&M salary costs. So it's not recovered as those salary costs are incurred. Capitalized labor is the recovery of, recovery on. So the recovery period starts when the asset is placed in service and runs through the period of time in which that asset is in service.
Right. So I guess my last question would be, if in base distribution rates at the time of the last rate case, there was a set number of internal labor that was approved in rates for revenue recovery. And then now at this point in time, we're using actual costs incurred for those employees that have been working on this tier 2 LiDAR improvement. Wouldn't that mean that you could have a discrepancy between like a full FTE that was included in base distribution rates? If that individual working on this project was incurring more costs than the capitalization carve out, if that makes sense, or less, right? It could be less. Couldn't there be a discrepancy there?
There could be, but there's a couple of different factors that are going to play into this. So one is the number of employees that you have as of the last case and the current number of employees that you have. So I'm making up numbers, but say we had 530 employees in the last case, and now we have 560. I only have my starting point on that revenue requirement that I'm currently earning right now today, sitting here, is the 530. Shareholders are paying for the incremental 30 people. Now, to your point, if I had 500 versus the 530, right, then shareholders are paying for more than what I actually have. The second thing that you're asking for is the capitalization rate. So I said those 530 people, 20% of them would be working on capital, but now only 75% of them are working on capital, or vice versa. More of them are working on capital. All those would play into, at the end of the day, what is your base revenue requirement for your O&M? But I can tell you, since we didn't get any future plant in the revenue requirement, so we didn't get any capitalized labor in the revenue requirement, I haven't run the numbers, but I'm fairly confident to say the current revenue requirement is not recovering that capitalized labor, recovery of or recovery on.
Right, the associated portion, but not necessarily an apples to apples, like what was actually presented in RAM isn't necessarily equal to the carve out for the capitalization and distribution, correct?
That could be correct. But
Might be.
it might be,
could be
yeah.
exactly the same by some chance. but-
Yeah.
Yeah.
If we went back and looked at the numbers, which I think we did, in the most recent case, 24-1004, we were over the head count, significantly, which would, in theory, mean that there is no amounts for these in the current base rates.
Right. So at least in regards to RAM, I know that capitalization is more unique, right? We don't have, UI doesn't typically have as many
Correct.
projects that they're capitalizing for recovery in RAM. So, okay, that's understood. Thank you for your responses.
Attorney Bowman? Good. Okay. All right. Thank you, authority staff. OCC?
Morning, Tom Wheel for the Office of Consumer Counsel. I communicated this to Attorney Vaughn, but I'm sure the commission will be happy to know that our 2-hour estimate was far overestimated on the 6 late file exhibits in this case. I'm going to start with just some quick follow-up on the discussion that you were just having with authority staff. Mr. Arpin asked about internal controls to prevent double recovery as between labor expenses, between distribution and the RAM components, like the SBC and the NBFMCC. What about the O&M for the EV program? The authority authorized labor expense for that in 220808, and then those EV program costs were allowed in the RAM in 240104. Is there any crossover as to the labor expenses there?
Morning. That would fall under the same, again, the employees have to record all of their time, all of their working time to a charge code, and that charge code has to be reviewed by their manager. So the EV employees have a specific charge code that they would be charging their time when they're working on the EV program. They might be doing other things like coming here and sitting with you, which is a different charge code. So
I don't want to see that.
but all of their time goes to that WBS code.
Yeah, thanks. That was kind of the nature of my question, actually, because I would assume after 220808 that charge code for the EV program would be charged to distribution rates because 220808 did allow for FTE costs for the EV program in distribution, but then 240104 in final decision allowed EV recovery in the RAM. So do you know where like those, like when an employee charges their time to EV, whether that's recovered in distribution or the RAM?
Now it should be the RAM. So, and I can go back and double check for you, but what should have happened is those employees in that charge code is now, when someone's pulling it out of the system, they're pulling it and putting it into the RAM versus putting it into the distribution. So when we go pull the charges, we pull it by the work order. We look at the underlying work order, and that's where you source it out to, depending on which case you're in. So if you're looking at distribution, you'll see we take certain time charging out of it. And same for the RAM, we would pull it and put it in where it belongs.
Okay, thank you. My next question is about late file 1, attachment 1. Which is the capitalization policy. On page 16, which discusses software, it says the capitalization threshold is generally $100,000, except in the case of regulated utilities such as NYSEG and RG&E, who each have $500,000 thresholds, and BGC, which is $50,000. What's the capitalization threshold for UI?
For new applications, it would be $100,000.
Okay. And why do the different companies have different capitalization thresholds?
They're stated in their rate making, specifically New York. And the idea behind it is that you would reflect in your revenue requirement as expense those applications that are less than $500,000, as opposed to putting them into rate base and having a return on and a return of, as Ms. Van Luling earlier explained. So they're still in there. It's just a different treatment.
Understood. Okay, so for NYSEG and RG&E, if labor is less than $500,000, that doesn't go into plant, that's built into the base rate.
Right. And it'd be the total cost of the software development. So you have the license fee and any implementation costs, labor, internal labor, external,
Oh, I see. Okay, the threshold is for the total project.
total project. Yeah.
Okay. I have a couple of questions about the narrative response at lay file 1. My understanding from the narrative sort of towards the bottom, it seems to be explaining that the tier 2 LiDAR costs are classified in the company's perspective as enhancements, like software enhancements. Is that correct?
Yes, or betterments. Yep.
Okay. So with that, going back to attachment 1 on page 17, there's sort of like a table of different, would that go under like Roman numeral 4C?
Yeah, exactly. Yep. So it depends on the actual activity that's being performed and then what stage of development the software is in. So this is an operating system, our billing system. And so it's an upgrade or enhancement to an existing operating piece of software.
Okay, thanks. That made me wonder, and maybe I have already asked this question, or maybe as to a different project, but for something like enhancing software, where, for this, and I'm not suggesting that the company, that this is a prudence issue at all, but for the tier 2 LiDAR setup, like we now know that we had to redo it to a 5-tier LiDAR. So that investment in enhancing the software for tier 2 isn't going to be used for its whole expected useful life. But the software itself, like the billing system itself, is really like the underlying asset here. How does that work in terms of like, how do you retire an enhancement like before it's like expected depreciable life?
We would need the business to evaluate if the code is actually still useful or not. So that's something we would have to follow up on. I mean, we can do a partial retirement. With group depreciation, things just sort of recycle. And so your rates are set, your depreciation rates are set again in the future for whatever investment didn't survive. So it's a little different than, sort of your accounting 101, where if you wrote something off before it was fully depreciated, you have a direct income statement impact. So, if the code was no longer used and useful, I mean, I'm not an IT person, so perhaps they just can amend it with less incremental costs to make it from tier 2 to tier 5. Then we would consider that it's still used and useful and that there is another incremental enhancement and would continue to depreciate.
Okay. Thank you. And the company hasn't sought recovery of the tier 5 investment yet, right? Is that correct?
That's my understanding that still would be, I hear that's correct behind me. Yeah, still a work in progress.
Thanks. On my next question is about late file 2. And I have questions about every late file, so I'm going to be going in order. But not very many questions. Late file 2 is about the MPP match for the accounts that didn't have an arrearage. I recall during the first hearing that the company expected that any matched accounts here would be $0 because if they didn't have an arrearage but they're enrolled in MPP, there wouldn't be a match. But as we see, there is this tiny $240 rounding up match. And I think I understand from the narrative what happened, but can you just confirm, can you explain like how these matches ended up going through for these accounts?
Yes, so the accounts didn't qualify to be enrolled, meaning that they did not have an old enough arrearage to qualify, but they still had balances. So let's assume somebody uses $100 a month, but they were on a $50 budget. They pay the $50, there's still $50 available for us to match.
Gotcha.
So that's why there would be some matches on those accounts.
Okay. And I was going to ask, I think that explains, but I was going to ask for account number 1 seems to have like the earliest match, which was December 2nd, which as I understand it, would be like the first billing cycle after this change to the MPP, but so that's probably what happened with that account, is that even though the arrearage wasn't old enough prior to the MPP changeover, like that's how that ended up
Yes.
going through there?
Yes, without looking at it specifically, that would most likely be the scenario.
Okay. Thank you.
And I would just, from looking at this and thinking about, potential weather impacts and seasonality, if we look at the first two cycles, if the budget amount was set for a 12-month period, you might see higher amounts in those winter months. So that would be the larger match. And then we get to, month 4, which would be coming into spring. Now it's a $2.37 match, which is much closer to the actual usage based upon the budget.
Okay. I'm a little confused now because I thought these numbers at the top of this table were just designating like the accounts, not the months.
That is, yes.
Okay.
The 1 through 9?
Yes.
Yes, that's just representing the account.
Okay. So you just now, for that $2.37 match for account number 4, that was February.
That was
right?
February. I'm sorry.
Okay.
Was reading that incorrectly myself.
Okay. Gotcha. All right. I think that's all my questions for late file 2. So next I have questions on late file 3. So this is, my question's actually a bit going back to Exhibit F, which the late file was tying to. I read the narrative response a couple of times and I still don't really, I'm hoping someone can just walk me through on Exhibit F, like how the calculation, like how the company actually got to the total at the bottom of the bottom line of the calculation.
Let me try and get up Exhibit F.
Sure.
Online here.
So like, yeah, Exhibit F has I think 4 or 5 different similar calculations for each of these projects. So like we could use Exhibit F page 20 as an example.
Not sure I have. Thank you. Okay, which page?
20?
20, yes. Okay, so in the, I think referring to the settlement agreement in the answer, we're following a formulaic approach to defining what and you're specifically asking for the calculation that results in the, what number here?
I think I didn't understand either the 1.446 million in red or the 3.9, or I guess that's the 3.906. I think that's also million. I was also a little confused by the
Whole dollar. So
because at the top it says in parentheses dollars and millions, so I wasn't sure.
I guess that refers to just the top part of the numbers there, which are in millions, and then the bottom part is in whole numbers. Well, it's calculated that way anyhow. So the total market revenues, which is the 1.4 million numbers, is a reflection of forecasted or the actual revenues that are defined for 2024, right? That's the sum of, in this case, it's a fuel cell, so it has a capacity set of revenues and energy revenue and a rec revenue.
Yep.
And then the calculation of market revenues retained by UI is based on that 0.27% of it is the calculation that results in $3,900.
Okay. So, and you get to the 2.7% by taking the equity proportion of rate base times the 0.0025, then grossing that up for tax. Okay. I think I was, okay. I think so the total cumulative offsetting credits, that's not part of this calculation.
It was set within 30 days of each project going into commercial operations, and it's set for the life of the project.
All right. Gotcha. That's what was throwing me off. I was starting at that 59.3 and couldn't like figure out, but I get it now. Thank you. Late file 4, I heard the correction this morning that one of these lines that says Bridgeport fuel cell is supposed to say Bridgeport solar. Was that the first line or the second? Okay. Thank you. The 9.35% ROE, that's, I looked at the 120105 RE01 decision. So that's the current authorized ROE plus the 25 basis points. Is that how?
Current authorized ROE and the 25 basis points, yes.
Okay. So that's using the 9.1 ROE rather than the 8.63 that's based on the adjustments in 220808? Okay. And I think that's my last question on late file 4. For late file 5, which is also on renewable connections, I noticed that there were 2 separate charges that are labeled intercompany charges from UIL admin support. It's both the op and maintenance serve int and tech sh serve. It's like the 3rd and 4th charges. Can you explain what those 2 charges are?
Yeah, there's that's associated with the time for myself and an analyst that works on supporting all of these projects and the month-to-month maintenance and that sort of thing.
Okay, so it's 2 different employees.
Yeah.
That's why it's 2 different lines. Okay. The 20-year operations and maintenance contracts, are those the costs paid to fuel cell to operate the sites?
For the 3 fuel cells, the solar site is treated differently.
Yep. Yeah, I saw that. But so for the Bridgeport fuel cell, for the Bridgeport, New Haven, and Woodbridge fuel cells, that line item is what fuel cell gets paid?
Correct. Net of, according to our contractual terms, net of any performance related guarantees.
Okay. What are the city of Bridgeport utility bills referenced in the second to last row?
Yeah, that's 2 items. It's $31,911 is related to it's the city of Bridgeport Water Pollution Control Authority, as well as a minor piece of it is was added in as far as the frontier communications that are necessary for the site.
Thanks. And I assumed that the Woodbridge cost on the same line is just the frontier communications costs?
It is. Actually, it's not necessarily Frontier. It's actually Optimum that we use there for communications.
Okay. I was just kind of struck by the size of that Bridgeport one is like $2,700 a month, right? So is that's how much the city of Bridgeport Water Authority bill is?
Sure. Bridgeport WPCA, the water is Regional Water Authority, which is $15,898.
Okay. So just sewer alone is like,
Yeah.
Oh, okay.
Yeah, we have all of the bills that I reconciled with.
Okay. And last question on this. Why does the New Haven fuel cell seem to have 2 separate water bills?
Regional Water Authority and the Greater New Haven Water Pollution Control Authority.
Yep, 1 water and 1 sewer. Okay. Thank you. And last question on late files is on late file 6, which is about uncollectibles. My question's on the second kind of half of the response. The sentence, to determine the annual uncollectibles, it's necessary to subtract the latest month end from the December balance for the prior year. For example, the 2024 uncollectibles amount is determined by subtracting the December 2023 from December 2024, as shown below. I was confused. Doesn't that just show the variance that's built in to determine the over or under recovery, but not the expected rate period uncollectible expense?
Yes, that does show the difference. The numbers, the 66 that we're showing in December 24 would be everyone that hit that status and is still in that status as of December 2024. So it's not just newly recorded uncollectible. So that's why maybe we misinterpreted what the question was asking for, but that's why we answered it that way, because we thought you were looking for newly.
No, okay, understood. Yeah, I was just confused by the, I mean, like, I just wanted to make sure the rates that are set for actually the current rates that are in effect for May would reflect the 66 million actuals from 2024 plus the recovery of the under recovery from that's reflected in that third column, right? Because that plus the variance, the amount that the company didn't collect in 2024 because revenues were not set high enough to recover that 66 million.
Attorney Will, we may need you to repeat that question.
Sure. So in 2024, revenues were set for the company to recover the, in every year's RAM, we set revenues to recover the expected expense for every line item. And we base that expected expense on the actuals incurred the prior year plus known and measurable adjustments. For uncollectibles, there aren't usually known and measurable adjustments. So we just kind of set rates to say, oh, so last year we would have said, at least with respect to financial hardship, your 2023 actuals were 36 million. So we're going to set rates to give you 36 million as a baseline. And then there's also the question of truing up from the prior year. But then as shown here in 2024, actuals were actually 66 million. So the 30.681 million that's shown in the total 2024 column, that would represent the difference between those two. That's like the true up. But then also rates need to be set now to recover not just the true up from the prior year, but also the upcoming rate period. And that would be based on the 66 million, right?
Right, and I think our intent here was to give the answer of how much did they grow in the last year.
Okay. Gotcha. I just wanted to make sure. I got confused and I said, oh my God, have we been doing the RAM? Have we been speaking a different language for 15 years? But I think we're good. Would it be possible, and thanks for the first half of this question explains what I think I already understood, which is that a major driver of the difference between the filings and the affordability dockets and the RAMs is the difference between the 120-day and the 180-day threshold. Would it be possible, just systemically, for the company to, in those affordability dockets, and then recognizing we would ask for it there, to start reporting 180-day numbers as well?
Yeah, so there was some reporting limitations, and we're actively pursuing the ability to break out not just the amounts in that bucket, but also the number of accounts. So it says I have some better details for that 180 plus bucket.
Okay. Yeah, because it'd be helpful for us to see, like, as the year progresses, the 180-day mark, recognizing, as you put out here, that all that ultimately matters for the RAM is what that looks like in December. But if we could see it in, September and follow it along, it would be easier for us to kind of get a sense of what the RAM looks like, if that makes sense. So
It does. And, to the extent that, there are other interested parties in seeing that, we want to be able to see that as well.
okay. My last question is just generally a rate design question. I think I saw Mr. Kolka here, but maybe he might not need to answer it. It's just, my question is just approximately how much time the company needs to design rates, like after the final decision is issued. And the basis of my question is that the recently passed but not yet signed legislation that potentially allows for bond authors, like bond funding for RAM line items. My assumption is that, for, like, hypothetically, if that were available as of this update, the authority could kind of write that into its final decision to say, we recognize the revenue requirement for this line item is X. The company can get bond funding of Y. Therefore, rates will be set to collect Z, which is the difference between those two. Just trying to get a sense of timing of, like, how long the company would need to kind of design the volumetric rate to recover the finally authorized revenue requirement.
I think we have Mr. Kolka joining us in a moment.
Thank you.
Morning.
Sorry, Mark, just for the record, Mr. Kolko was previously sworn in as a witness and has testified before in the RAM hearing. So if you could just state your name and title.
Mark Holka, Manager of Pricing for UI. Like to have about 2 to 3 weeks.
Okay. And does it not, I guess what I'm wondering is, right now, I assume that you have a good idea of generally what the final revenue requirements are going to look like. Does it matter, like, do you need more time if the number is different? For example, if, like, bond authorization, if the company got bond revenue of $50 million in some line item, that would reduce the rate revenue requirement by $50 million, so the company would just have to calculate it, like, based on that changed revenue requirement. Does that have any impact on the timing at all, or is it 2 to 3 weeks from, like, when the final rate revenue requirement number is established?
That would not affect the timing for the rate calculation. I can't speak to what the revenue requirement group would have to do.
Okay. Gotcha.
Yeah, Mr. Will, I think as a company, we're uncomfortable of saying 2 to 3 weeks for every rate change. Certainly, there's a lot of business requirements, and I know you just brought up the idea of the bonding specifically, but we are closely looking at that specifically. But there are a lot of changes that come through PURA decisions or come from legislation that require a significant amount of work, looking how it works with our systems, and it can take significantly longer than 2 to 3 weeks. Once we certainly figure out the business requirements, and have our vendors on board if it requires a system change, then when it comes down to the actual change to the rates, it could be 2 to 3 weeks, but it can take significantly longer.
Understood.
Yeah, and that's without a rate design change. That's just calculating it. Rate design change, I mean, we'd have to see what it looks like, but that could take a few additional weeks over that.
And there wouldn't be a rate design change necessary if it's just a difference in the revenue requirement number, right? Like, if the current NBFMCC revenue requirement is $500 million and then that changes to $300 million, and that's the only change, that doesn't require any rate design adjustment, does it?
Correct. At the rate level. Once again, the revenue requirement level, that's a different issue.
Understood.
And I would just caution again, because we haven't had this scenario before with the bonding funds, I think that's our best guess at this time, but I can't say for sure that we wouldn't see something along our review of implementation that would change that estimate.
Okay. Understood. Thanks. That's our last question for this panel.
Thank you. Thank you, OCC. Commissioner Karen? Thanks. And I do not have any questions either. Attorney Vaughn, would you like?
Yeah, can we have 5 minutes?
Yep. 5-minute recess.
Thank you, Commissioner Arconti, for the latitude on the timing. I'm sure I went a little over the 5 minutes. We have just brief redirect when everyone's settled. Ms. Van Luling, earlier today, do you recall cross-examination from Purist staff regarding the inclusion of capitalized labor in your distribution rates?
I do.
And did the company's compensation expense included as part of its proposed revenue requirement in docket number 220808 exclude a percentage for capitalized labor?
Correct. It excluded the capitalized labor. So the capitalized labor percentage is not in the revenue requirement.
Thank you. Ms. Prescott, do you recall cross-examination from the Office of Consumer Counsel on EV labor expense?
Yes, I do.
Do you have any additional information you would like to add regarding the inclusion of that expense in the RAM?
I do. I wanted to point to Exhibit F, page 3, line 179, labeled UI EV labor and expense non-bypassable FMCC, which totals an amount of $233,153.26 for calendar year 2024. And in reaction to the question, which was talking about whether or not it was in distribution rates or in the RAM, that labor was for incremental labor that was not included in base rates in docket number 241004.
Thank you. And lastly, Ms. Van Luling, do you recall cross-examination from the Office of Consumer Counsel on the potential to reduce the company's revenue requirement based on bond funding via pending legislation?
I do.
Do you have any additional information on the company's experience or similar experience in other jurisdictions that you'd like to add?
Sure. So we did securitization, which is very akin to the bond funding in our New York entities. It's the most recent securitization that has been done, and it was the fastest securitization that's ever been done in the United States. It was approved by the governor of New York in June of 2024, and it was not executed until February of 2025.
And I'd just like to add to that, in that scenario, I believe that was Avangrid leading that securitization effort. In this case, in reference to the bonding, one, I do not believe the governor has signed the bill yet to make it an official public act, and therefore we're not in control of that. So we were just pointing out the timing that it may take, and that it may not. We don't feel it would be appropriate to consider for adjustment to this year's RAM.
Thank you very much. That's all the redirect we have.
Thank you, Attorney Vaughn. Do you have any administrative matters before we adjourn today?
Nothing from me, no.
Okay, thanks. Looks like next event in this docket is briefs are due June 20th. So with that, I would like to adjourn today's hearing. Have a great afternoon, everybody.
Thank you.